guys, welcome back to the Wall Street Skinny. Today is our private equity deep dive, where we're going to get into the specifics about everything from how to land the job, specifically navigating the path from investment banking. And by the way, we're going to touch on the importance or lack thereof of having the quote unquote right pedigree, both as far as your education and your employment experience before you get into the private equity field. We're going to understand in depth how a lower middle market private equity fund, meaning something along the lines of like $2 to $5 billion in assets under management, works, and why it is so different from a mega fund in a ton of important ways. We're going to understand in way better detail fee structure, things like GP catch-ups that you may have heard about that you're like, what the hell is that? Investing strategies, the works. And we're going to finally get into the nitty-gritty of what the lifestyle looks like and what a day in the life is actually like. And for those of you who are new here, I'm Jen.
I'm Kristen.
And we are two lifelong friends with a combined 25 years of experience working and teaching on Wall Street. And we're here to give you the skinny on some of the world's most elite careers. Now, I'm still getting up the curve myself on private equity because I came from an institutional interest rates background. So I learned so much during this interview. And Kristen, you're the one who had the connection to our guest today. So can you share a little bit about how you know him?
Yeah, so today we're speaking with AJ Tracey. He is our private equity expert. And AJ is awesome. It's actually a funny story. So we worked together back in my teaching days, but when he was like initially hired, I had never heard of him, but then I saw he was a Brown alum. He was my brother's year. And I pinged my brother. I was like, have you heard of this guy, AJ? He's like, oh my gosh, yeah. I guess so. My brother was a swimmer. And so he roomed with a whole bunch of athletes. And one of them was a football player. AJ was on the football team. So anyway, it's like always like this kind of small world situation. But AJ is honestly, I think like just one of the best people that we could get on to explain some of this stuff, because he has taught what are the basics of private equity at universities, at private equity firms. He actually taught courses on this at Kellogg, which is his alma mater, and he'll get into that at the University of Wisconsin Green Bay. And so again, there's just like no one better that I can think of to help us dive into some of these mechanics of private equity than AJ. So we're just like, I'm so excited to have him on and catch up with him because he's actually just really cool. So we are super excited to be joined today by AJ. We actually go back. He was 2 years below me at Brown. And actually, Jen, it's been a joke because we have so many people who are Brown alums on. Although I actually met you not like from Brown, but when I initially met you, I was like, oh my gosh, we have this connection. So anyway, what I would love for you to do is basically give us an overview of your background, what got you interested in private equity, how you ended up working in finance, and then your path into private equity and what you're doing now.
Yeah, originally from Oklahoma, don't really have any sort of business relationships in my family. My father was an officer in the U.S. Air Force. My mother was a school teacher. Even really my path to university was really just sort of fortuitous. Academically did decent enough, athletically did decent enough to get recruited into the Ivy League. Ended up choosing Brown in large part more from the team's dynamic more than really knowing what I was getting into. And I tell that portion of the story because then at Brown, that same ideology played into how I chose my career path, which was didn't really know anything about what opportunities were out there and met a lot of really unique and interesting people through the alumni base and through some of the connections of folks that I met at Brown, and kind of heard about this idea of investing in taking concentrated positions in these companies and really helping to try to transform them and to grow them into sort of the leader within the industry in which they operated. And that really just resonated with me and I was like, oh, this is really intriguing. And so the summer between my junior and senior year at Brown, I worked for an alumni, a gentleman named Richard Dresdale. He had founded a firm called Fenway Partners. He had been at several storied traditional private equity firms. And so his guidance was, look, in reality, there's sort of two classic paths into private equity. One is through the investment banking route, learning the very technical aspects of capital markets, of finance, of how we think about value and value creation. And the alternative is consulting, much more about value creation and working with management teams on how to create value where there may not have been an obvious path before. And those are two classic paths. There's also a direct route into private equity, but I would say that that's a little bit more limited. There are some funds that do hire directly. There's a good example off the top of my head would be Stone Point Capital out of Greenwich, Connecticut, fantastic firm focused on financial services broadly. Great group of people, and they hire anywhere between 4 and 5 analysts per year directly out of undergrad. And so these are, you can imagine, the top of your class from your traditional finance programs, Wharton, Michigan, University of Texas, et cetera. Not easy to get into. So graduated in 2008, right? Fantastic year to be graduating from university and right in the middle of the financial crisis. And, in my senior year, I had actually started the investment banking recruiting process. The recruiting cycle in investment banking and private equity has really accelerated, meaning that you are signing these commitments or basically interviewing several years, probably in a stretch, 18 to 24 months before you oftentimes are starting your position.
Question. So you had already worked in the private equity industry through your internship, but there wasn't a return offer to go back to that. You were now coming through the traditional investment banking route to then re-enter into private equity is the ultimate goal?
I wasn't doing anything in private equity other than watching him, do private equity and like I was basically taking care of his kids, so like it was I used
to pick up my boss's dry cleaning when I was in interest rate sales as an associate, so I get it.
I was a male nanny, effectively, it was that's what I was.
Include this. This is
amazing.
It's very real.
I mean, you're gonna get real here, guys. Yeah. So I went from male nanny to investment banking, and this is why I got my teeth kicked in my first year. Yeah. I got curb stomped my first year. Yeah, so there was no learning, really there. It was just that I liked the concept, right, of all the career paths that I could go down.
It sounds great.
Yeah, right. Exactly. And just to click on it, there are very few direct opportunities into private equity. And even those
increasingly so, though, that there are
I think it's just market efficiency. I think what folks have started to recognize is that the best talent is easier to go ahead and acquire directly out of undergrad. And it's kind of what I was speaking to. As you look at the recruiting cycle, I started recruiting for an associate position in private equity in my second year. These days, people would look at you like you had two heads, right? So now,
last year, some hadn't even started training for their first job in investment banking, and they were already, it was July, they were getting the mega funds on cycle recruiting had kicked off. It's absolutely bonkers.
Yeah, and we can talk about a little bit later about sort of how the recruiting works in private equity funds, but you're oftentimes partnered with a search fund, and there are several fantastic groups out there, Henkel, Dynamics, Amity, Bellcast, and these folks really help the private equity firms, which tend to have limited HR functions, to be able to go identify these candidates and recruit them. And oftentimes, everybody that is, I would call it lower middle market or middle market funds, so Kainos, we were $2 billion, we really were staring at those that are helping us recruit and saying, when Apollo goes, when Blackstone goes, when they say go, because what they do is they send out invites to these candidates in training and they say, show up to our office, and it's like a 24-hour super day process. I'm using the gun, to your head. So like we're in Dallas, Texas, and we're waiting for the phone call and someone to say, hey, Blackstone's going. And then we're on a plane to New York to try to compete, right? We're trying to create these events and try to recruit and differentiate to attract the best talent we can.
You're walking up and down 6th Ave trying to intercept these candidates on their way into
Absolutely.
It's like, oh, funny running into you here outside the halal stand. Like
Exactly. And, and it's gotten to the point where everyone knows, what's occurring, and they're very candid about who they're interviewing with. And it becomes, especially being a non-New York fund, to differentiate on geography. You're trying to recruit somebody maybe from the East Coast or California, and you're trying to say, hey, come to the Midwest, come to Dallas. Even though it's a great opportunity, it's a great fund, you've got to convince someone that Dallas is a great place to be for the next 2 to 3 years for your associate program. But back on, the history,
back to 2008.
So
your graduation start.
So one thing, that was interesting is my senior year, right? So the world's melting down. Bear Stearns had already fallen. I get an offer to join CIBC as a generalist in the New York office. The Canadian Imperial Bank of Commerce, still around, less U.S. presence, particularly on the advisory side. And then in November, I get a phone call and they say, hey, unfortunately, we've had to sell our advisory business to Oppenheimer, and we're rescinding all offers. And so I find myself going into the holidays with the need to go back into the recruiting process and figure it out. And found my way to Jefferies, found a great team. This is sort of pre-Ben Lorello coming into Jefferies, and he did a really fantastic job of bringing the firm together. But prior to him joining, it really was sort of these disparate offices of M&A advisory focused on different industries. And so I was joining the Boston office, which focused on tech M&A. then specifically mostly M&A advisory. We did a little bit of equity. It was a really fantastic opportunity to learn about the technicals of finance and just how capital markets worked. But I quickly found that I really did not enjoy tech or didn't have any interest in tech. And I'll talk a little bit later about why curiosity matters in this industry. But, I just didn't have curiosity around the tech industry. And so as I thought about my path and I knew that there was this private equity outcome that I was really looking for, it forced me to start thinking about, well, what industries would I actually be interested in investing in? And, I'm a 270 pound, 23-year-old, and I like food, I like, these, this is what I like. And I like things that I can touch and I can feel, I can pick up, I can talk to someone about, I can point to on the shelf. And so as I looked around the country, I wanted to be closer to home, kind of wanted to be more focused on what I would call old world economy industries, light industrial manufacturing, food, paper packaging. And there's a really great group called CIC Partners. As with most private equity funds, they're all sort of derivatives of each other. So we call them like the children. So if you think about like your Tiger hedge fund, Tiger Global Management, all the different Tiger Cubs that came out of it. For most private equity firms, you can trace back to the large, big funds. And so CIC was one of those. Joined those guys, fantastic group of individuals, 4 partners that were really focused on 4 independent verticals, different industries. Paper packaging was one, food, healthcare, and then because we're in Texas, everyone does oil. Right? So had to buy a book called Oil 101 to even figure out what a PDP and PUD and all that decline curves was.
Ooh, proven. No, what is it? PDP. I used to know this.
So a PUD is proven undeveloped. And then there's PDP, which is proven developed producing. And then I'll stop there because I'm sure I'll just embarrass myself.
Well, one quick thing that I just wanted to interject and say, one of the things that kind of just makes me so sad for the people who are starting now is, as you put it, you were like, I joined tech. That's because I thought I wanted it, but I didn't. I wasn't curious. So I said, what am I curious about? And I think what sucks for the new crop of people who are basically now being forced to figure out what they're interested in before they've even started. You don't know. And it's so disappointing because, again, you were able to adjust course in real time because you're like, I'm seeing what I'm doing. This isn't interesting. Oh, this is, okay, I'm going to do that. And I think it's actually just very disappointing how the landscape has shifted how it has. But anyway, continue.
Yeah, the competitive nature of getting the job has removed the ability to organically develop your own passions and seek those out on your timeline. You're on someone else's timeline. So you're like, I guess I'm passionate about tech.
Yeah, I think naturally the best investors that I've had the opportunity to work with generally had a knack for having a natural curiosity about the industries in which they were evaluating, which really helps you, one, develop the competency side of understanding the industry, but then also you end up just naturally building relationships, right? And then you start to have that network and what I'd call the warmth side of the 2 aspects that I think really make a great investor is warmth and competency, right? If everyone's in sales.
I've never heard that before. I love that.
Yeah, because I can walk into a room and then act like I'm the smartest guy, and I can just come at you with all the stats and all the facts. But if I can't connect with you on a human level and really just try to develop some basal relationship with you, it's probably going to be challenging for us to do business. And
we talk about that so much as sales, but it's warmth is such it's a better marketing word for it. It's a better tagline, better PR. Mm-hmm.
Yeah, I agree. For you to find value and to be a great investor, you oftentimes have to stand in your own truth where you see opportunity or you see value where no one else sees it. Because otherwise it would be priced in, right? If we just go nerdy and we go economics, if markets are efficient and all the information is priced in, then we pay the market price and we get the market cost of capital, right? Or return. Right. And so where private equity and a lot of alternative asset managers are really, what they're trying to execute on is an ability to pay a price that is far less than the value. And oftentimes that value has to be sort of diamond in the rough. It can't be obvious. So that non-obvious outcome that you're trying to pursue often requires you to persuade others to take that same viewpoint. And that persuasive tactic, that ability to sit in a room, whether it be with your LPs, your investment committee, the management team on the other side, or the seller, and try to convince them to collectively back your viewpoint, I think the 2 kind of key ingredients is that warmth and competency. And both of those are really developed by being in an industry, having that real curiosity where people will see that you have a genuine interest, and you will be a better investor for having taken that path, in my opinion.
Oh, no,
That's
1000%.
fabulous advice. That's absolutely fabulous advice.
One of the things that, again, has become such a big topic of conversation and is huge in our online space is this idea of like target school, right? Or target firm.
Yeah.
And the signal that your college or the firm that you were at, like, was it Morgan Stanley M&A? Was it Goldman Sachs M&A? Or, was it
Jefferies,
like Citigroup?
Yep.
Yeah. So can you talk a little bit about the path to getting into private equity? We have so many people that ask, hey, I'm not at a target school. Can I get into private equity? I mean, what are you seeing? Is that still the case that it's pretty hard to get in if you're not coming from a target school? Is there any shifts you're seeing where people are maybe a little bit more open to taking a chance on someone who doesn't have the right pedigree? What is your kind of viewpoint on what you're seeing there?
Yeah, I mean, so for like the mega funds, like I don't know if I can necessarily opine upon them, but I would say that the smaller middle market funds, the way I think about it is there's so limited HR function within these firms, right? Most private equity firms are a collection of individuals that are deploying the capital, so we'll call it the front office investors, and then you tend to have a CFO and like a controller, fund controller, and an executive assistant, right? That boom, you just got a private equity firm for like the lower middle market. So hiring and recruiting talent, oftentimes it's episodic because you maybe have an associate leave to go to business school. You maybe just raised another fund. You need another associate. Oftentimes you're hiring VPs every time you raise a fund. So that's 5 to 6 years. This is lower middle market. And so because you don't have that HR function and you're spending so much of your time on investing, you've got to have some sort of filter or mechanism for filtering down all these resumes to get some sort of signal about the collection of individuals you want to even interview. And that's the unfortunate reality about where target schools, target firms come in, is that there's just natural signal in that, look, if you were able to be accepted to that school, perform at that school, get accepted to this firm, perform at that firm, I can get references from that firm, there is enough signal in that path that you can be successful here, subject to the interview and you just naturally fitting with the firm's culture, things like that. And so
it's an efficient gating mechanism.
It's an efficient gating mechanism. So do I think it's an absolute barrier? No. I think that can be overcome. But just recognizing that it is a signal and that you're going to have to overcome, and sometimes being upfront about it, to people. It's like, look, this is why I chose to go to, I don't know, Colorado versus, Brown. And so it's not on your target market unless you're Piper Jaffray. I ended up going to Chartwell Advisors out of Minneapolis. I know it's not on your target, investment banking list, but here are the skill sets that I developed here and these were the mentors that I had. And this is why I think it's applicable to your firm. And this is why I want to be here. Yeah. This is the unique value I see. So if you think about it as an investor, if I can have someone come to me and be able to demonstrate that they know where their value is and why that's applicable to me, I can say, this person is going to be able to go look at a company and and figure out what's valuable about that and unique about that and go, help execute on a real investment. That's how I flip it around and say why I might be willing to interview or hire that individual.
Show me you're scrappy. Show me you've got grit, right? And I'll take that person who demonstrates that 100 times out of 100 over the person who's like, you should obviously hire me because of my resume, right? Like, what's that?
Yeah. And I mean, it's kind of like looking at an investment. There's 1,000 reasons to say no, right? I need to find the reasons to say yes. It's like, I got a 3.4 here and, I wasn't top of my investment banking analyst class, but this is the incremental value that I can bring to you. And this is what it probably doesn't snap off the resume right off the bat. Yeah. And that I actually find to be really, really compelling. I think there's going to be adversity in private equity. You have to be able to, what's the right word? Constructively criticize. You're going to have to be able to have disagreement, but yet be
and handle rejection, right?
Handle rejection, failure, right? It's I'm biased, but I think athletes do fairly well because they're used to having failure, being individually accountable, being a part of a team, all of those sort of things. So I would tell people I didn't graduate anywhere near good grades at Brown. I was a terrible analyst in investment banking, absolutely terrible. But, I worked on those deficiencies. But when I went to talk to people about a career in private equity and investing, I focused on the things that I was good at. I focused on the way that I differentiated versus other candidates, or I perceived myself as differentiated. And I focused on what I could bring to the firm. And I think that was probably to my benefit.
And, we also have talked about this as well, that like people who come from military backgrounds, it's another thing where it's like you tend to see people thrive going into like a finance type role, but the athlete thing is obviously huge. In general, almost like the more groups that you can be part of, like this XYZ club, this team, it's like the more things that you can then be part of, because then now all of a sudden you have built-in connections because
you
of
share
something
commonality with people.
Yeah, the shared commonality. It's like these are all things that people should be, trying to work and like looking at these opportunities, whether it's in college or wherever, that like, hey, I can be part of these different clubs, these different teams, try to meet as many people, and then you have the more commonalities you can use to your advantage.
Yeah. Totally agree.
Okay, so your offer got rescinded. You go through this whole path at Jefferies. You come into your own as a private equity investor, and you start your career. What were the most surprising things about starting your career once you really got into the investing side of things?
I think it was how little things could be black and white, just how often you were operating in the gray areas and you were really having to make judgment calls with imperfect information, oftentimes knowing that there was information asymmetries between, you and a counterpart across the table, and being able to operate in that environment. The other thing that that was really surprising and really made me start to think was really understanding human emotion and cognitive bias, and really being able to introspectively study yourself and understand my own heuristics and biases that were imparting themselves on my judgment and my decision making, but then also to be able to evaluate the other people around me on my own team and external teams on where they may be having different cognitive dissonance or biases and heuristics in their decision making, and how to navigate those challenges. So there was much more of a human element to investing that when you're an investment banking analyst, you oftentimes are behind the Excel sheet or behind the PowerPoint, and it's just
what does
very.
It say when I hit Shift F9, not how do I think critically about what the perspective is that someone's coming to this decision with.
Exactly. It's a very linear thought process. It's very tactical. There's oftentimes you're trying to come up with a black and white answer in terms of value. I mean, you oftentimes give a range in investment banking of these outcomes, and you use these different methodologies of valuation, but you're probably thinking a little bit more absolute, a little bit more linear. Whereas an investor, you think far more in probabilities. You're thinking about all these probabilistic outcomes, and do we have a skewed curve of outcome? Do we have a normal distribution of outcome? Like, what is it? Is it binary? That element, that behavioral cognition, you can name all the key books, Thinking Fast and Slow, all those kind of things come into my mind, because that was a big part of what I was surprised, by when I started that private equity side.
Well, because I feel like that's something that I always would have tended to think more of in like the hedge fund space, but it's so interesting to hear that. I mean, in both cases, you're making investing decisions. Obviously, with private equity, you're actually then trying to implement change at the company level, versus with a hedge fund is more passive. But again, the idea that, hey, I'm looking at potential outcomes. This is what my thesis is about this investment. That might not actually happen. And then all these things could go wrong or whatever. So it's a really interesting perspective.
Or why do I think about this so differently than everyone else does? That really challenging thing of, like you said, standing there in your truth, which sounds like something from like the Real Housewives. Like, I'm standing in my truth about
Right. Yeah, and I think different than even like a hedge fund, though, to click on that, with a private equity firm, you're really taking concentrated positions, oftentimes control positions.
Yeah.
And as you start to get into your mega funds and your upper echelon middle market funds, you tend to have what I would call professional management teams, where you're either bringing in a whole new management team, or there already is an existing, call it professional management team, that wasn't necessarily like a family member or the founder owner of the company. As you start to go lower middle market, kind of where I played, you oftentimes are backing the CEO is the owner, or it's a family member, or, in some cases, one company we evaluated, 26 family members were operating in the business from CEO all the way down to shipping and receiving, like working a forklift, and you start to have to think about incentives. So you do this transaction overnight, this family makes $500 million. Does that forklift operator show up the next day when he just got $1.5 million in his bank account? And so you start to think about incentives, you start to think about behavior, you start to think about what is the outcome on the other side of this transaction with this person that is both my counterpart on the purchase sale agreement, but also going to be a manager and a board member on a go-forward basis. You're building a partnership here, and that is probably distinct from the hedge fund world of the passive ownership, typically with professional managers. And so that's where that human side is something that's really unique.
And I know we're going to get more into the human element and the model versus the reality in a little bit. But actually, I wanted to ask, because I know you then went to business school. Was that something that it was formalized at the time at the private equity firm you were at, in that did they expect you come in for 2 years and then you exit, go to business school and then come back? Or was it a decision that you made that you wanted to go? I'm just curious what sparked the decision to apply and then attend business school.
Yeah, so I think I was probably at the cusp of the generation of associates where there was startly more of a path for direct promotion to the vice president, senior associate type role versus having to go to business school. I think, call it back in the 2000s and 1990s, there was very much a standard program. You're going to do 2 to 3 years of investment banking, 2 to 3 years of private equity. You're going to go to business school, come out as a VP. And that was just kind of a classic path. And in a large part, the business school gave you a broader network. You're going to be meeting the future executives that you're probably going to be backing in investments. I mean, there's a lot of arguments for that business school path. I think for me at CIC in particular, I kind of got to my second year, was contemplating business school. 3 out of the 4 partners had gone. I kind of viewed it as an opportunity to codify a lot of the learnings that I had had over the past 5 years of investment banking and private equity coming from a liberal arts undergrad, and then wanted to be able to explore different paths on a go forward. I wasn't convicted that I wanted to stay as a traditional investor. There was a side of me that wanted to be on the operational side. Being in the lower middle market as a private equity investor, you tend to be pretty hands-on in your investments. And so I ended up spending a significant amount of time on site for many of my investments, basically acting as interim CFO when there wasn't one, or as their support to do board reporting, KPIs, treasury management, capital markets management, while I was an investor. And so getting some of that quasi-operating experience started to become a little bit interesting to me. And so there was an idea of going to business school and then trying to pivot into an operating role somewhere. Today, I think we would call that sort of that search fund. We see a lot of this entrepreneurship through acquisition, search fund, but that was sort of in my mindset at the time. It wasn't really well defined. And so as I started evaluating it, you get the classic HBS Stanford, right? A lot of the guys I worked for were HBS grads. Wharton's always in that mix. Booth in Chicago, Kellogg, Columbia. Tuck has got a great program. So these were all kind of classic business schools that everyone's thinking about. For me, Harvard was on the top of my list. Wharton was on the top of my list. And the Chicago schools, Booth and Kellogg, were both in the mix. And so I ended up applying to Harvard, Wharton, and Kellogg. Got dinged at Harvard, got into Wharton, got into Kellogg, chose to go to Wharton, put in my offer, and then I met a girl. And she was living in Chicago. And so we were dating in my 3rd year. And so I ended up rescinding my offer to Wharton. And Kellogg was gracious enough and gave me the opportunity. And so I went to Kellogg for my 2 years. And Kellogg, for those of you that don't know, I mean, Kellogg has really evolved over the past few years. But when I went, it was much more of a consulting and marketing school by reputation, if you will. But Dean Blount and Dean Corneli have done a really amazing job highlighting that there is a tremendous community of private equity investors globally. It's some tremendous funds that all graduate from Kellogg. It's not always about just the hardcore finance. It's about building relationships and seeing value where others don't. And so sometimes that consulting, marketing, sort of liberal arts type mindset can actually be more valuable. So they now have an Apex program. It's highly focused on alternative asset management, in particular private equity. So they've really changed since I left. But had a great experience at Kellogg, met a lot of really great folks, and then afterwards went to a fund called Kainos Capital. I was their first mid-level hire, so first VP. Wow. Finished off Fund 1. They had just raised Fund 1 about a year and a half before I joined. Finished off Fund 1, invested most of Fund 2, and then left to go run the Chicago office of a captive fund under TIAA-CREF that was focused on agribusiness. And I would have honestly stayed at Kainos for my career. Fantastic group of individuals, investors. It was a family reason for moving. And then COVID hit and wanted to get out of Chicago.
I wanted to pause on one thing. I remember when we first met also talking about like how many frequent flyer miles you had. You were like platinum status on like everything, and we're like
concierge key. Concierge key on American Airlines.
Oh man, so that's some legit status there.
I think I did 135,000 miles in 1 year. Everyone's going to laugh because they're like, oh, you think that's cool. It's because you didn't have a private jet. So the real thing is if you get that, what it points out is that you guys didn't have a private jet. So because most of the time you would prefer to have the PJ. Because investing in food, you're going to BFE, Nebraska. You're going to middle of nowhere, Wisconsin. So you're either doing a triple connection flight, or you got a
Oh
PJ
gosh.
that's going to land at the
Oh, yeah,
FBO.
yeah, yeah. No, but I always would think about consulting as having the most travel of the different types of roles. But then private equity, because you are going to the actual portfolio company, you're flying to the actual site, you're flying to their manufacturing facilities, they're actually going to all these different places. There might be a decent amount of travel involved.
Yeah, I would say there's one misconception that I think a lot of folks have, and it's probably to their detriment long-term career-wise, is that they think that if they can go grind it out for 2 to 3 years in banking and they get that buy-side offer, that it's going to be easier, that it's going to
Yep.
be less time. And that is a complete misconception.
Mm-hmm.
You may have more control over your time, maybe a slight amount, but the job doesn't end because
Yeah.
you could in theory work 24 hours 7 days a week, right? You can always be thinking about new investments. You could always be thinking about how to optimize your existing investments. There is always an opportunity, and so finding that balance is really challenging. And like I said, if you're going to go find value where no one else sees it, it requires legwork, right? Building
Mhm.
relationships requires legwork. So getting on a plane, going where others won't, that's how these firms that really are successful differentiate relative to their competition.
Oh,
Mm-hmm.
I
At the end of
love
the
that.
day, we're selling dollar bills, right? It's a commodity, right? We're
Mhm.
selling money. And
Mhm.
so really being able to convince people that we are different, that our dollars are different, that our
Uh-huh.
dollars actually are worth more than someone else's
Mhm.
dollars can be challenging, but really requires that human connection. So being on the ground with people in front of them
Yeah.
matters.
Oh, that's such an important point.
Think about it this way.
So,
When the deal closes, the sell side's done.
yes.
When the
Mm-hmm.
deal
Yes.
closes, the buy side,
Mhm.
the real work now begins. It's easy to buy a business. It's hard to create value and sell a
Mhm.
business.
Well, that
So,
was what the joke I always used to hear, which was when you're working in investment banking, it's like a one night stand. Whereas when you are in private equity, you're getting married. Now, technically, it's with the intent to divorce after 5 years or 7 years or whatever, but you are getting married. You have to work through all the problems. Now, this thing is yours. The hard work begins versus banking. It's like, oh, okay, deal's done. On to the next one. But Jen, I know you had a question or you
No,
had
yeah.
something you
So,
wanted
so
to talk.
two questions for you. One, I want to find out what happened with the girl. And two, you talk about how differentiating your dollars from someone else's works. I'd love to dig into that a little bit more. Also, in the context of how private equity is viewed by the public in terms of its impact on corporations. Because if you're selling your dollars to a corporation, my guess is they want to know that this company that they have built and poured their blood, sweat, and tears into is going to be in good hands while they simultaneously make as much money as possible. How do you reconcile differentiating yourself from other competitors and also thinking about those impacts on companies that so notoriously in the news have been destroyed by private equity firms and the reputation of private equity as corporate raiders? So first the girl and then the company. Those are my
yeah,
two questions.
sure. Yeah, so it's a funny story. So when I joined CIC as an associate, the very first transaction that I was staffed on was an acquisition of a large paper converter focused on the QSR, the food service industry. So think about Subway wraps, McDonald's bags, napkins, all the different disposable paper products in a quick service restaurant based here in Green Bay. And I'm dating myself, so this has been 2011.
You're
And
still
We're
younger than we
1,000.
are.
yeah.
Yeah, we're 105.
So we invest in the business, and for 3 years, I work with the CEO and our board and the CFO, and heavily involved in M&A activities and pricing discussions. Would fly with the CEO to Yum Brands to talk about landed cost of product, and talking to Javi McDonald's, which is the purchasing organization for McDonald's, or our IPC. And in my third year, he calls me and he says, "Hey, my daughter is coming to Dallas. Will you take her out to dinner?" And she's got a boyfriend, totally plutonic, and I said, sure. So
Talk
I
about going
take,
above and beyond to get the deal closed.
right? So, so I take her out to dinner. It turns out this is now my current sister-in-law. She wants to introduce me to her sister. So my father-in-law tried to stay one step removed. So I ended up marrying the CEO's daughter
Oh
at the end
my
of the deal.
God.
And
Oh
what's
my God.
what's funny about it is
So
we
it was
sold the
literally a
business.
marriage with the company.
It was. And we sold the business in the exact same month that I married her. So our firm, it was a great outcome. So we sold the business to a strategic, and we made 3.2 times our money. And I always joke that, I made 3.2 times our money and I got a wife out of it. So I think I got the greatest return out of this deal. So
you got the better end of the deal.
I got the better end. I didn't have to pay any fees or any carry on that one either. So it was great. So we got married, and that was the pivot to Kellogg, and she's been fantastic and supportive. And Kainos was a lot of work, and it still is. I'm on the road right now as we do this podcast, and she's incredibly supportive of the career path that I've chosen.
How do you guys navigate that balance with you being gone so often? This isn't something that we really talk about that much. We have a couple of interviews scheduled with a bunch of senior women who've all raised kids while being in the industry. But one thing we haven't really talked to the dads in the industry about is how do you manage being a present father and an involved parent while you're traveling so much for a crazy career?
I always say that there's no such thing as really like work-life balance. Like there's always going to be periods of time in which you're concentrated in one versus the other. And so I try to always tell my children and my wife that my head is where my feet are. So if I'm at work or if I'm traveling, I'm focused on work. And when I'm at home, when my feet are at home, I'm focused on home. And it's about managing expectations. There's definitely times where I violate that policy. But as long as I use the 80-20 rule and follow that, I'm good. I would say that I have an incredible amount of empathy for females in the private equity or in the buy side market, just because of the challenges associated with having the traditional gender role and responsibility for child raising, while at the same time having a pretty demanding and oftentimes inflexible schedule associated with getting transactions done. Because as we talked about differentiating or selling dollars, a lot of differentiation is through speed, right? And through speed and ability to close and having that certainty around closing. I think firms have done a much better job of being flexible with those schedules, a lot of more remote work, recognizing that a lot of times the female-male partnership in a marriage or any form of partnership, I shouldn't just make it gender specific, that there's going to be trade-offs. And so there's been a lot more willingness to have remote workers, both male and female, in order to satisfy the familial requirement, but yet still, working in the firm. So it's gotten better, but I think it's a continued challenge. And there's a lot of really great leadership, I think, at a lot of firms, female firms. There's a young lady at Payne Schwartz Hadley, and I think she just recently got married. She and I talked a lot while we were at Kellogg about that key issue. And I was at least encouraged to hear that she told me that there was a lot of really strong female leadership in the private equity ranks that were looking to make sure that they had carved a path for themselves. And they looked back to make sure that the folks that were following them, that they also had that pathway to be able to have the balance between a career in private equity, but then also, raising a family and being a present partner to their spouse and parent to their children.
Wow.
I love that. No, that's a really great answer. Thank you. It's something that it's a major issue for anyone, regardless of sex, marital status, whatever it is. And I think we're so often focused on the female perspective here. It's funny, we sometimes forget to ask the questions about men and what that perspective is like for them. But I think it's equally meaningful.
Yeah, my kids know what EBITDA is. My kids know, they know how to negotiate a credit agreement because they've all sat in the back of the car while I'm on a conference call driving around. So, and I was going to say the corporate raider, the stigma,
the corporate raider,
the stigma.
Exactly.
Well, I was going to say, I worked in financial sponsors in investment banking, helping private equity firms buy companies. And it was always this abstract thing. And then when I was working at a company that got bought by a private equity firm, my feelings were a little different about it. Everyone wants to paint private equity investors as villains, and that's obviously not the case. So what are some of the benefits of private equity investing, and what is your perspective, having also worked for a firm bought by a private equity firm and also being on the investing side?
Yeah, and it's probably, in some ways like a sensitive topic, because there are definitely some very storied situations in which there were private equity sponsors that maybe had taken a company private, maybe from the public world. I'm thinking about your Toys R Us's of the world, especially a lot of retailers in particular. This ends up striking. And if the plan doesn't work out and they ultimately have to go bankrupt, a lot of times people lose their jobs, they lose their livelihood. There might be a mill closing or a manufacturing facility closing. And oftentimes the headline is the private equity firm is evil and the investors are evil. So there are for sure negative outcomes that happen. There are outcomes and then there's intent. And I don't often think that there is a malicious intent upon a firm investing. And so many times I think private equity, what they're attempting to do is find assets that maybe have been underinvested, that likely could benefit from additional capital investment. If you think about what private equity firms or investors are generally trying to do, they're trying to create value. And so if you're trying to grow the enterprise value of a company, two key ways of doing it. One is, you could, I guess in theory, you could drive down the discount rate, which would increase the value. The other way of saying it would be to increase the multiple, which would imply that either the discount rate is going down or the growth rate of the cash flow is going up. And so the lever that most people focus on is that growth in cash flow. That oftentimes either can be cost cutting or you're investing in growing the revenue and in growing the business. I would say most firms are focused on investing in that growth and growing the business, whether it be new facilities, new product lines, through M&A, roll-up strategies, et cetera. But there are some firms that focus on cost cutting. And so there are firms that make the mistake, right? We are, as investors, oftentimes have information asymmetry. We're a buyer, we're sitting across from the seller. The seller, by its nature, has more information than we do. So we're trying to evaluate whether we want to enter into this partnership, enter into this marriage, and we're evaluating the information that's being fed to us, and we're asking for guarantees that the information is correct in all material respects, usually. That's what we're asking for, but we don't know. And so if we could make the mistake of going in and cutting costs and taking actions on reorienting the business or reorganization, changing out leadership, consolidating manufacturing to less facilities to reduce overhead, et cetera. And that can have real negative consequences. Sometimes that knock-on effect, that second-order consequence of decisions can have really negative outcomes. And I think that's oftentimes what makes the headlines in the news. But there are also firms that are focused on investing in what we call loan-to-own. So maybe they're buying debt that is marked down, cents on the dollar, and they're looking to be the fulcrum security in a bankruptcy type situation. And those investors have an incredible amount of savvy. And if you want to talk about folks that are willing to stand in their own viewpoint and take a counter view to many other folks, those folks are impressive. So I actually think that the funds that I worked with and worked for, and for most of the people that I have trafficked with in the industry, we're all growth-oriented investors. And so there are times where we have to evaluate cost-cutting measures, and sometimes those do impact people. But for the most part, those are limited and far and few between. And we're trying to think about ways of optimizing the growth. And basically, generally, every dollar that's being reinvested in the business has a return, an incremental return in excess of the cost of capital. And that's how value is really created. And so that's where really the focus becomes. And so we're trying to generate a thesis on the outset before the transaction closes that we then go execute on. And so a lot of the firms will have they'll call them proprietary, but they're playbooks. And so I think Vista Equity is like a great example of that. They have a very well-documented playbook that they're going to implement, and that's their strategy for each of their portfolio investments. Every firm kind of seems to have their own proprietary playbook that they're going to go execute on. And everyone's got different strategies. There's a lot of firms like Riverside Company, Align Capital. Those folks are taking a viewpoint on an industry. They find a great operator, and they're going to go try to roll up several small players at discounted values. And then the combined platform should have what we call multiple arbitrage, or just general scale value increase. And there's firms that are going to use a lot of leverage, and we're going to put as little equity in as we possibly can. And we're just going to try to grow the business just enough, but that's going to double our equity because we just put in so little. So there's either financial engineering or there's your value creation from the asset side. And I'd like to argue that we're trying to do the value creation from growing the assets.
So if I had to summarize what you've just said in a very, thoughtful and diplomatic way, is the stereotype and kind of lazy critique of private equity is that the only way that they generate returns is by cutting costs. And that's simply not the case. That the goal is for diligent operators and for people who hope to be good stewards of the asset. The goal is growth through actual growth, not through cutting of expenses.
That's right. There's very few cases where you're going to go buy a family-run business and that family has just been, fat in its costs and has just been totally mismanaging the operation. Most of these folks have already been pretty diligent in that it's their livelihood, right? These family businesses, right? So they've been focused on the bottom line as well. So sometimes you find yourselves that they've underinvested, right? And so we end up a lot of times out of the gate, if you look at the EBITDA of most companies right after purchase, it oftentimes dips. And that dip is because the firm is investing in talent. It's investing in the operations in order to get that scaled growth. I just don't think it makes the news when firms are successful. Then no one's going to be like, hey, the KKR, really grew that business,
right.
It's challenged.
We've listened Christian shared a podcast with me from some private equity guy. I can't even remember. And it was like an hour-long sales pitch about how they pride themselves on not firing CEOs. They're like, we have the highest retention rate of CEOs. It was like this PR sales job of basically like, we're not villains. Please don't hate us. Please let us buy your company.
I think there's an analogy. One man's freedom fighter is another man's terrorist. And so if you look at 3G and their acquisitions, they're very smart folks, and they, have some principles that I think I know about. Some of them being like zero cost budgeting, right? So we're gonna rebase. Well, basically, we're going to rebase our costs and our viewpoint on how to allocate costs on a budget every single year down to like basically redo it. We're going to restart. We're not going to just say last year we spent $500 million in marketing, so this year we're going to spend 550. No, you're going to have to go basically repitch sales and marketing organization. You're going to have to go correct. You have to go restate your business case for why we need to spend even the $500 million again. So that's kind of the zero-based budgeting, right? We're starting from scratch each year on making a business case for any spend.
Whenever he was developing Tesla, he was like, this part, you say it can only withstand these temperatures. Try again. Is there an actual law of physics that says it is, right? Like,
correct.
I mean, there's nothing wrong with that approach. It sometimes leads to innovation.
Asking the 5 whys. Why, right? And you can get to like truth. And so like my point about the freedom fighter terrorist comparison is like, look, sometimes these organizations, they have bureaucracy or they just have like general cost mismanagement. And, it's like looking at the U.S. government, you're like, oh my gosh, how did you spend that much money? And it's so
LBO of the U.S. government.
Right. So it's
already LBO'd.
Yeah, exactly. All right. So, but that ultimately is kind of like people look at it and they say, oh, well, you're cutting these costs, which sometimes it's people. And it's like, well, that's bureaucracy that never, ever should have been there. In those cases, I think it's just looking at the same issue from two different perspectives. At the end of the day, 3G is a fiduciary. Their job is to maximize the return for their investors' capital. I mean, even Caesars, right? There's a fantastic book out there, The Caesar's Palace Coup.
We did our
that's the book that we did
unbelievable in its scope and breadth, right?
Yeah.
Right.
And hats off to the Apollo team. I think they get positioned in the book in some negative light. I actually found, if you take it to perspective, it's their job. They are hired by the firm representing limited partners, typically global pension funds, state sovereign wealth funds, et cetera, to maximize returns. And they were trying to find opportunities to preserve equity value through propco, opco. And I'm not going to opine upon fraudulent conveyance, but my point being is don't worry. They were doing their best and gave that company far more runway and extension than most would. I think a lot of others would have thrown in the keys far before that. And I think they put a tremendous amount of effort. And if you think about return on effort, theirs probably was pretty low. And so I do applaud the amount of effort and time and energy that firm put into the company, even knowing that they were likely working for the debt, at that point.
What's your view on, in the current interest rate environment? Obviously, a lot of people are scaling back their Fed cut estimations for this year, but I'm curious, we get a lot of questions about the sustainability of existing debt that's been taken out over the past, call it 3 to 4 years in the private equity space coming due for a refinancing, that we're going to see a wave of distress. Do you think that that's accurate?
Oh, man. I guess if I knew this, I'd probably be a billionaire and sitting on the beach somewhere. I think there will be challenges. I think that the sponsor community and the leverage finance community have really gotten a lot closer in lockstep to understand what's coming, what the right course of action would be for those situations, and how to work together to come out on the other side intact and whole. Obviously, low interest rate environment, leverage multiples were creeping. Again, not to date myself, but when I started private equity in these light industrial asset manufacturing businesses, if you were paying 6 to 8 times, 8 times you were kind of choking on it, 6 times you were feeling pretty good, and you get leverage at 3.5 to 4 times. Right now, 6 times leverage is, that's easy, right? Now you've got these holdco PIK debt, you've got different layers of debt where, you can start to put in very thin layers of equity. COVID hits, right? Everything changes. I think there's been a evaluation of leverage relative to enterprise value in the marketplace. There are probably a lot of companies that, if their projected growth has not occurred and they have this refinancing of debt with a step up in basically the service cost of that debt, there's probably going to be some challenges on cash flow. I think a lot of sponsors are, probably going to either have to put in additional equity and call additional equity to right size the loans in that refinance scenario. But lenders recognize that for the most part, a lot of these leveraged buyouts, if you look at the market over the past 10 years, they're mostly tech, right? And what I would call cash flow businesses. There's not a lot of collateral. There's not a lot of assets. Lenders aren't in the business of taking over these businesses and operating them. And in particular, if the management team gets wiped out and from their equity, they oftentimes leave. So lenders are not looking to foreclose on these businesses because they're going to get pennies on the dollar if they do so. And so that's where I think that there's been a tighter relationship on workout, because everyone recognizes that having the fund still engaged and incentivized to get to the other side of this is likely going to benefit all parties involved.
That's a really good point, especially as a contrast to Caesars, which was all physical assets, right? That had gotten moved around, obviously, but we're talking hard casinos and a Britney Spears contract. We're not talking about, a plan to develop AI that's now going to, sous vide chicken.
I think they also, though, had debt to EBITDA of like 18 times, or it was something bonkers. Maybe it was 10.
By the end.
I feel like by the end, it had gotten like so distressed. But not all investors even use leverage. So that's another thing to think about is in the lower middle market, are a lot of the investments that you guys make, are you using leverage?
Yeah, our firm takes a little bit of a different view. We're oftentimes using, I would say, more moderate leverage levels, typically not stretching into your second lien mezzanine debt. So we'll typically take first lien and then equitize it, in large part because our strategy oftentimes involves M&A, in which we want what we call debt capacity in the existing investment to take on leverage to execute on an M&A transaction. And so I think it largely depends upon the strategy of the investment. So whether or not the firm is looking to grow the business by additional investments in equipment, infrastructure, facilities, or if they're looking to just cash flow. So if it's going to be a GDP grower, we're just looking to cash flow the business. You oftentimes, in order to hit the equity returns demanded by LPs, you oftentimes have to take out a decent amount of leverage in order just to get the equity account right sized for the growth of the business. If you have an M&A strategy directly out of the gate, or you have a growth strategy where you want to equitize the balance sheet, oftentimes people will take lower leverage just to allow for more flexibility. You don't never want to just we call it no whammies, but miss an interest payment or miss a payment on the debt because you've invested all this capital in CapEx and now you don't have the cash flow to service the debt. So you may be under or over equitized, don't use as much debt in order to execute that strategy.
What does equitize mean? I've never heard this verb.
Jen, by the way, has an interest rate background, so she's getting up the curve on the.
I guarantee you, there's half our listeners out there who are like, yeah, and secretly like, I have no idea what the fuck that means. So what does equitize actually mean?
So I mean, just think about like out of 100, like I got a box, right? If I can either lever it up and use $99 of leverage and $1 of equity, or I can over equitize. And when I say over equitize, like what's the relative? I would say. More equity relative to what the market would have bared. Like somebody would have offered me 6 times debt, and I take 4.5, right? And so
putting it into speak because Jen is again a real estate agent by day, so it's like you could put 10% down, you're going to put down 50, 30.
Right.
Whatever.
Right. You're understood. We've talked about a lot of these ratios. I've simply never heard the term equitize, so I want to make sure that I understand it on behalf of all of our listeners who might share my confusion. Kristen's told me that, you've started your own fund and worked as the CFO of a portfolio company simultaneously. Can you touch on a little bit of what it takes to start your own fund? Like what the actual mechanics behind that are like in that experience?
So, private equity firms are usually, it's the general partnership, right? That's the actual operating firm, and then they raise funds underneath. And the term gets mixed all the time. You're at a fund, right? But the reality is we're an independent sponsor. So Jonathan Dyer is who I would claim is the founder of the firm. He and I have been working together since 2010. And he had started Cartess back in 2015. I had been at Kainos the whole time. And in 2021, I partnered with him and co-invested with him in Rev1, which is the company I'm now CFO of.
Got it.
Yeah. And then a year later, he said, hey, can you step in to be the interim CFO of Rev1 while we stabilize it? And so I stepped in as the CFO of Rev1. But to answer the question, I mean, starting a private equity firm is incredibly challenging. And I'll talk about it more in general terms, but you're really having to convince investors, LPs, to provide you a commitment of capital that is, they call it blind pool capital.
Sorry, we haven't talked about this yet, and we haven't defined that term, and people talk about it all the time.
Okay. So at Kainos, when we raised our second fund, $900 million fund, we have these limited partners that invest, and I won't name names for confidentiality reasons, but let's say a large sovereign wealth fund, they'll commit $100 million of the $900 million fund. When the day that fund closes, it's not as if they send you a wire for $100 million. They're simply making a contractual commitment that in the future, when you find an investment, they don't have to agree that they like the investment. You just get to call capital. So if I go invest say $90 million into a company, that's 10% of the fund, I email them and say, here are the wiring instructions for 10% of your commitment, whether they like it or not. And if they don't, and I guess they could default on it, but it is a legally contractual commitment. So that's what they call it's a blind pool. You're pooling your investments into a fund, a limited partnership that then is going to be deployed by the general partner, and you don't know at the time you commit, you don't even know what they're going to invest in.
Thank you for defining that. I appreciate it.
And so there's a big focus on LPACs now, so limited partner advisory councils, being very clear about scope. We're allocating you capital. You are a food fund. Don't go start doing tech. Don't start doing oil and gas, right? Because that's not your competency. We're investing in NGP for our oil and gas, and we got Vista Equity for our tech. Thank you very much. So you guys keep on food. And so scope creep, size creep, at that allocation, because the limited partners are thinking about fund allocation, right? So maybe I've got 15% to alternative asset managers, and within that, I've got these breakdowns. So that's a blind pool.
Got it. Cool. I have a quick technical kind of dorky question, but again, now I'm realizing that I've never actually understood this. When you talk about the return that the sponsor is targeting, is it from the point that the capital is called? Is it based on this is the amount of money that we have invested? How does that work?
So yeah, it's a great question. The ticker doesn't start whenever the commitment starts. It's as capital is called. And so there are different types of waterfalls for how it's determined, basically how the split between the private equity firm, we call it the carried interest, right? When it occurs, how it occurs, if there's a catch up, or basically if there's a preferred return to the investor, the LP, and is there a catch up? There's a European versus an American waterfall. There's all these different, very technical
elements. About European versus American waterfalls before, but we failed in that episode to capture the GP LP catch-up structure. Is that something you could touch on briefly?
The European American is just the timing on which carry gets distributed. But in effect, if you ignore that aspect with the GP catch-up, so for the most part, you can think about it this way: investors are going to get their money back plus fees. So as that 2% fee continues to go in, that accrues to the kind of capital balance. And different firms have different offsets. So typically private equity firms are charging management and oversight fees to the portfolio company. They're charging financial advisory fees at the time of transaction. And a lot of times LPs demand offset, so they're not double dipping. So if you're charging those fees on the portfolio company, we want that to offset our 2% commitment fee, and so depending upon the negotiation that you have with these LPs, that can occur. So let's just say the fund starts deploying capital, a couple years later, it starts harvesting some of their companies, the wins. And so first you're just returning capital, right? So you have to return all of your commitments. And there's all these calculations that the CFO is doing on whether you're in the money or out of the money, depending upon the paper marks, because you're doing these quarterly valuations and you're doing these theoretical marks on these investments. And they're usually fairly conservative. But things can go wrong, and all of a sudden that mark can go to zero. But basically, there's oftentimes an 8%, it can be simple, but oftentimes it's compounded preferred return. And so every year, that capital base increases by 8%, and we'll call it the hurdle. And the carried interest keeps on getting further and further out. And so you have this.
So basically, you put in, I'm actually going to call it $100 million just to make it easy.
Yep.
So you put in $100 million, 8%. So the next year, you have to basically pay back to the LPs 108.
108. But so let's just use that simple example. I invest 100. We call 100. I invest 100. So a year later,
Sure,
with the 8% preferred return, I have to return $108 million before I'm in the carry. However, if I have a catch up, let's say I sell the business for 150 million.
Okay.
I get every dollar above 108 million until such time as I have received 20% of the profit distributed. So basically, they got $8 million of profit. Now I get every dollar as if I had participated in that $8 million of profit. And then we split every dollar thereafter 80-20. And so that's the catch up versus we split 80-20 above the 108. That's the nuance.
Awesome. No one's ever explained that to me, so I really appreciate it. Okay, so you were talking about how you actually went out and raised this fund. Sorry, before I was like, help it.
So we have so most firms have blind pool. Now that requires a lot of trust, right? Limited partners. And so track record, having this long tenure, demonstrable history of being a good capital allocator. And as a person raising a fund for the first time, what I would say is that they are not just great investors, they're great at identifying other great investors. And so building a firm that actually has staying power, that's not just a fund, like fund one, fund two, and then burned out. Someone that has staying power, Clayton, Dublier, and Rice, right? These story groups, KKR, Blackstone. You can look back at the founders of those firms and the first few echelons of management. And what's clear is that they really were business builders, and they were able to identify great talent to go build a firm that has staying power and isn't just going to be one or two funds. So those are funds. And like I said, those are usually investors that have storied backgrounds, that maybe left another firm to go raise their own money with a unique strategy, et cetera. You got to get limited partners to make commitments. Or you can be a little bit more scrappy and entrepreneurial. That's kind of what we're at. So Cartess, we're what's called a fundless sponsor, independent sponsor, which means we basically are a firm that raises money on a deal-by-deal basis. So now, rather than being able to call our investors and say, you owe us 10% of your commitment, we call investors and say, here's a new investment. Would you like to allocate any capital to this?
Oh, so you're pitching each investment
Yep.
and they aren't required to go in on it. So you might
Correct.
have an investment idea and not know if you have the capital to allocate to it or not. You've gone through this whole analysis and now you've got to pitch it to everyone before somebody else figures it out and gets in on the deal.
Which is the biggest challenge. Now, typically we would have a deal under LOI, exclusive. So it's not as if we would have time exclusively to not worry about someone snaking the deal from us. And we would be out, trying to raise money from investors. But for certain, especially in this environment where people are uncertain around the economic conditions under which we're operating, it is much more challenging to raise money on a deal-by-deal basis. And so if we did have a blind pool, it would be way easier. It'd be so much more easier because they don't have a choice, right? We call the capital and we get to deploy it in what we think is a good deal, all things being equal. The benefit of that, though, is typically the economics are on a deal-by-deal basis. So in a blind pool, a zero can impact the carry for the entire fund because you're having to average the returns. You're basically taking a portfolio view on the returns. In an independent sponsor model, I could have one be a 10x and one be a zero, and I still get carry on the 10x.
You don't have to socialize those losses across the entire investment pool.
Correct. Now, that black mark on my reputation, though, to have a zero is like it's going to hurt the next fundraise. Next time I try to raise money for a deal. But that's where the independent sponsor model has come into play. It's also a little bit easier to be patient, and my mindset is I never want to feel the pressure to have to put money to work. Those blind pool commitments have timelines, so there's an investment period. There's oftentimes some extensions that can occur, and you can only charge fees for a certain amount of time on those pools. And so there's a pressure to get capital deployed, even in environments where you may feel like the price tag for these assets is getting really high and you're starting to really get squeaky voiced whenever you start saying, I'm willing to do a deal. Because at the end of the day, as a private equity investor, right, in the public markets, I can look and see what people are willing to pay for a security, like a stock, In the private markets, I'm going to enter into this process. If it's with an investment bank, like a Harris Williams, I'm going to bid on an asset and participate. And there is a difference. Some firms will not participate in auctions, investment banking auctions, and they'll argue that they're going to go exclusively proprietary, directly to the owner. Challenge with that is actually finding someone that's willing to enter into that transaction and then certainty of close, so
that's just like all my clients who say they don't want to bid in multiple offers. Okay, so you'll never get a house.
Right.
Enjoy. I'll see you in 5 years.
So But what you know for certain is if you're in a fund or a firm, anybody, and you win a Harris Williams auction, the second you just found out you won, you just know you paid more than 200 other private equity firms were willing to pay for that company in the country.
Yeah.
So either you're really, really smart or you're really, really dumb. And so it's oftentimes when you win the deal that you're the most like, oh my gosh, I'm just the dog that caught the car.
Yeah.
So now what do we do with it? So there is some benefit to being able to be patient on deploying capital in a fundless sponsor because you don't have that timeline of this commitment sitting in your background.
And one quick question. I assume that the fees that are charged on, like, if you have like the blind pool, the fees don't start, like the management fees don't start until the capital's called. Is that correct? Like you don't start paying
So the 2% is on the commitment. Because that is oftentimes that's what's covering your overhead, right? So the GP is only making money that got to keep lights on, travel, salary. So the 2% is on the commitment. Yeah.
Wow.
Yeah. So the 2% is on commitments. And typically a fund is not ever 100% deployed. So you typically get to like 70-ish% and you start raising your next fund. And you'll typically hold back 15% of the commitments for reserves, for add-ons, for any additional capital. There's always fees and things like that. So right around 70% deployment of a fund is when a firm starts to go back out to placement agents and start getting back out there to re-raise a fund. And so oftentimes you hope by the time you get 70% deployed, those early investments have started to either the marks are high or you've actually exited and returned capital. Because you want to, we always call it like hanging skins on the wall, right? You want to put up your trophies on the wall because that's going to put,
Finance lingo is always hilarious.
Right? Yeah, I know. And maybe it's a Southern, I don't know, these people down here.
That's a Texas thing.
Shoot deer and stuff.
Speak a little bit about placement agents. That is a little bit of a black box to us. I mean, it sounds really sexy, right? Like, hey, you just like connect these rich people to these opportunities to invest and you take a huge commission. Like, who are these? I've never met a placement agent. Like, I would love to meet one.
There are a lot of really great firms. I think Lazard has a really good practice. There's a group called 6 Point Partners has a great practice as well. And, you think about it, you have these humongous asset managers out there. Your partners groups of the world, APG, which is a portion of the Dutch pension. You have CPPIB, Ontario Teachers, Montreal Transport, CalSTRS, CalPERS, the Public Retirement System of Massachusetts. So there's all these groups out there. And if you're a private equity investor, you're focused on investing in these companies, you may not have the full landscape of limited partners that are looking to allocate funds to your particular strategy, right? And so where the placement agent really comes in and is valuable is being able to understand your strategy, what kind of risk profile, because at the end of the day, all we are doing is allocating risk. I'm trading dollars today for the promise of dollars in the future. And I'm trying to assess the risk and the tolerance of that outcome. So they're almost like wealth managers, right? They kind of know the risk tolerance and how much of a portfolio that these large asset managers want to allocate. And then they help connect them to managers, GPs, private equity firms, that are allocating dollars with that risk profile, that industry, that sort of size, outcome, everything. And they're a tremendous value because the universe out there of investors is so broad. And they can really bring to bear resources to help get those folks of the line. Because there's a lot of diligence that those folks do on the team, on the strategy, on the firm. And so they can help really shepherd that process.
How does that differ from like a marketer? I know in hedge funds,
they're internal within the fund, right? Versus a placement agent who's external. Like they're not within a private equity fund.
Is it usually like the smaller firms that don't have marketers that are going to placement agents, or is like Blackstone going to placement agents too?
I don't know if a Blackstone necessarily is. I mean, so you tend
they're probably turning down money.
Right.
I'm sure they might. I don't know. You tend to have investor relations folks within firms. I mean, we had some fantastic investor relations folks in Kainos, and we were, I think 2 billion AUM is probably the best way to put it.
Yeah.
Those megafunds have whole teams on investor relations side. I still think, though, that there is some value in having a placement agent involved. I'd say the difference between a hedge fund is the frequency of redemption or the lockup periods and how redemptions are occurring. It's a little bit more frequent with hedge funds where we're talking about on typically a 3 to 5 year fund cycle for raising. And so it's a little bit more episodic, and therefore having a dedicated internal team versus having a placement agent.
Complete sense.
And similar to like
That makes so
HR
much sense.
functions, the owners of the GPs would like as much of that cash flow as possible to their pocket.
Yes.
And so, spending less on my bonus and spending less on, more back office personnel is going to be beneficial. And so those placement agents, like I said, they can really do a great job of connecting you to firms that you otherwise would have had no connection to.
No, that makes complete sense.
You're
Again,
a phenomenal
especially-
teacher.
yeah.
You have explained this structure and this process
Well-
better than anyone. Our listeners are so lucky
AJ
to have
does. You
access to your brain.
You teach at a university now, right?
I taught advanced corporate finance at the University of Wisconsin Green Bay for a little bit, and I taught some courses at Kellogg, some seminar courses. I haven't taught in the last year though, so but I do enjoy it, and I think for me, I always think about teaching as the best way of learning, and like I said, I came from a liberal arts background, and I'm a pretty simple-minded person, and so I like to boil things down as simple as possible, and so I think forcing myself to explain them to somebody is the best way for me to sort of internalize them and learn more about them. Yeah. Mm-hmm. So I appreciate it though. Thank you.
You're speaking my language.
Awesome. You've done an amazing job. We are definitely coming up at the end of our time here. We are so grateful.
Thank you so
hope that we can have you back on to pick your brain, because I feel like we could have kept talking for another 2 hours, but
yeah, I would love to.
Utterly invaluable for anyone who's interested in private equity investing. I mean, this is the Bible as far as I'm concerned. And anyone who's thinking about overall fund structure from an investing standpoint, thinking of where to deploy that capital, knowing how thoughtful you are about your approach, I mean, that should certainly give people a lot of confidence in the overall sector of the industry. So we appreciate it.
Yeah, well, thank you so much, AJ.
Kristen, Jennifer, thanks for having me on. Really appreciate it. It's been really fun.
Awesome.
Our pleasure. Take care. Stay warm in Wisconsin. And
thanks.
And we'll talk to you soon.
Great. Thanks, guys.
Thanks again
Bye.
so much. Bye.